Welcome back to Smart Currency Tube. In today's episode, we're diving into the intriguing world of market timing and its critical role in investing. Have you ever wondered if you could predict the best times to buy or sell stocks? Or perhaps you've experienced the frustration of watching your investments fluctuate wildly. Understanding market timing can be the key to unlocking your investment potential, and that's exactly what we'll explore together. Throughout this episode, we'll break down the concept of market timing, discussing its significance and how it can impact your investment strategy. You'll learn about the various methods investors use to gauge market conditions and the risks associated with trying to time the market. We'll also share some practical tips to help you make informed decisions, whether you're a seasoned investor or just starting out. But before we get into the details, let's take a moment to reflect on your own experiences. Have you ever tried to time the market? What were the outcomes? By engaging with these questions, you'll not only relate to the content, but also gain valuable insights into your own investment journey. So, stick around as we unravel the complexities of market timing and equip you with the knowledge to enhance your investment success. Market timing refers to the strategy of making buy or sell decisions in financial markets by predicting future price movements. Unlike long-term investing, which focuses on holding assets for extended periods, regardless of market fluctuations, market timing aims to capitalize on short-term price changes. This approach can be enticing, but it also carries significant risks and requires a keen understanding of market dynamics. One of the key factors influencing market timing decisions is psychology. Investors often let emotions like fear and greed dictate their actions, leading to impulsive decisions that can result in losses. For instance, during market downturns, fear may drive investors to sell at a loss, while the excitement of a bull market can lead to overconfidence and hasty purchases. Recognizing these psychological triggers is essential for making rational investment choices. To navigate the complexities of market timing, investors often employ various strategies. Some common approaches include technical analysis, which involves studying price charts and patterns, and fundamental analysis, where investors assess economic indicators and company performance. Additionally, some investors may use market sentiment indicators to gauge the overall mood of the market. By understanding these strategies and the psychological factors at play, you can make more informed decisions about when to enter or exit the market. Examining historical data and trends related to market timing reveals valuable insights for today's investors. Throughout history, there have been notable market cycles that illustrate the impact of timing strategies. For example, the dot-com bubble of the late 1990s saw many investors rush to buy tech stocks, only to face significant losses when the bubble burst in 2000. Conversely, during 2003, the S&P 500 index rose by over 20%, as investors became increasingly optimistic about the prospects for the U.S. economy. The recovery period following the 2008 financial crisis. Those who strategically timed their investments in undervalued assets reaped substantial rewards. Notable investors have had their share of successes and failures in market timing. Take, for instance, Peter Lynch, who famously advocated for a long-term investment approach but also recognized the importance of timing in certain situations. On the other hand, investors like market timer John Paulson made headlines during the 2008 crisis by betting against subprime mortgages, showcasing how precise timing can lead to extraordinary gains. However, many others have faced challenges, often missing out on significant gains due to poor timing decisions. Historical events such as economic recessions or geopolitical tensions can provide context for current market conditions. By analyzing past cycles and the strategies employed, investors can better inform their own timing decisions, learning from both the triumphs and missteps of those who came before them. Understanding these historical perspectives is crucial for navigating today's complex investment landscape. While the allure of market timing can be tempting, it's essential to recognize the potential pitfalls and risks associated with this strategy. One common mistake investors make is attempting to time the market based on short-term trends or news headlines. This often leads to impulsive decisions, such as buying high during a market rally or selling low during a downturn, which can significantly erode investment returns over time. The emotional and psychological toll of market timing cannot be underestimated. Investors frequently experience anxiety and stress as they try to predict market movements, leading to a cycle of fear and greed. This emotional roller coaster can cloud judgment, resulting in poor decision-making. Many investors find themselves second-guessing their strategies, which can further exacerbate losses and create a sense of frustration. To mitigate these risks, the importance of risk management in investment strategies cannot be overstated. Establishing clear investment goals, diversifying portfolios, and setting stop-loss orders can help protect against significant losses. Additionally, adopting a long-term perspective can reduce the pressure to time the market perfectly. By focusing on a well-thought-out investment plan rather than short-term fluctuations, investors can navigate the complexities of the market with greater confidence and resilience, ultimately leading to more sustainable financial success. If market timing feels too risky or stressful, there are several alternative investment strategies that can help you achieve your financial goals without relying on precise timing. One popular approach is dollar-cost averaging, which involves consistently investing a fixed amount of money at regular intervals, regardless of market conditions. This strategy helps smooth out the effects of market volatility, as you buy more shares when prices are low and fewer shares when prices are high, ultimately lowering your average cost per share over time. Another effective strategy is the buy-and-hold approach, where investors purchase assets and hold them for the long term, regardless of short-term market fluctuations. This method allows you to benefit from the compounding growth of your investments over time, reducing the pressure to make quick decisions based on market timing. Diversification is also a key component in mitigating timing risks. By spreading your investments across various asset classes, sectors, and geographic regions, you can reduce the impact of poor performance in any single investment. This not only helps protect your portfolio, but also enhances the potential for overall returns. Encouraging a long-term investment mindset can lead to more sustainable financial success. By focusing on consistent contributions and a diversified portfolio, you can navigate market ups and downs with greater confidence, ultimately achieving your investment objectives without the stress of timing the market. When it comes to market timing, insights from financial experts can provide valuable perspectives. Renowned investor Warren Buffett famously stated, "The stock market is designed to transfer money from the active to the patient." This highlights his belief in the importance of a long-term investment strategy over trying to time the market. Similarly, legendary investor Jack Bogle, the founder of Vanguard, emphasized that time in the market beats timing the market, advocating for a buy-and-hold approach that focuses on the benefits of compounding returns. However, opinions on the feasibility of successful market timing vary among experts. Some analysts argue that with the right tools and research, it is possible to identify optimal entry and exit points. For instance, technical analysts often rely on charts and market indicators to make informed decisions. Yet, many experts caution that even the most seasoned investors can struggle to predict market movements consistently. As you consider these expert opinions, it's essential to think critically about the advice given. While insights from successful investors can be enlightening, remember that every investor's situation is unique. What works for one person may not work for another. By weighing these perspectives and aligning them with your own financial goals and risk tolerance, you can develop a more personalized investment strategy that suits your needs. As we wrap up our exploration of market timing, let's recap the key points we've discussed. We delved into the definition of market timing and its significance in the investment world, highlighting the psychological factors that can influence decision-making. We examined historical perspectives, showcasing both successful and unsuccessful attempts at timing the market, and explored the inherent risks involved in this strategy. Additionally, we presented alternative investment approaches, such as dollar-cost averaging and buy-and-hold strategies, which can help mitigate the pressures of timing the market. The overarching theme is the importance of informed decision-making in investing. Understanding your own risk tolerance, diversifying your portfolio, and focusing on long-term goals can lead to more sustainable financial success. Remember, while market timing can be tempting, it often comes with significant risks that can impact your overall investment journey. If you found this episode helpful, we encourage you to engage with us. Please subscribe to our channel for more insightful content on investing and personal finance. Don't forget to like this episode and share it with friends or family who might benefit from these insights. Your support helps us create more valuable resources for you. Thank you for listening, and we look forward to seeing you in our next episode.